3:2 Sector Rotation Strategies. 3.2 Value-Based Sector Rotation. Evaluating sectors based on fundamental analysis and valuation metrics involves assessing the financial health, growth prospects, and relative value of sectors within the economy. By analyzing key financial and qualitative factors, investors can gain insights into the intrinsic value and potential future performance of sectors. Here are some steps to evaluate sectors using fundamental analysis and valuation metrics. Industry research. Conduct thorough research on each sector, including understanding the industry dynamics, market trends, regulatory environment, and competitive landscape. This helps in gaining insights into the sector's potential growth prospects. Risks and competitive advantages. Financial statements analysis. Review the financial statements of companies within the sectors to assess their financial health and performance. Key financial statements to consider include the income statement, balance sheet, and cash flow statement. Analyze metrics such as revenue growth, profitability, liquidity, leverage, and cash flow generation to evaluate the sector's financial stability and sustainability. Comparative analysis. Compare the financial performance and metrics of companies within the sector to identify sector leaders, laggards, and trends. Look for companies with consistent revenue and earnings growth, strong return on investment, and efficient capital allocation. Valuation metrics. Apply valuation metrics to assess the relative value of sectors. Common valuation metrics include price-to-earnings ratio, P/E, price-to-sales ratio, P/S, price-to-book ratio, P/B, and dividend yield. Compare the valuation metrics of sectors against historical averages, peer sectors, and the overall market to identify sectors that may be overvalued or undervalued. Growth prospects. Evaluate the growth potential of sectors by analyzing industry trends, technological advancements, demographic shifts, and macroeconomic factors. Consider factors such as market demand, innovation, regulatory environment, and barriers to entry. Identify sectors with favorable growth prospects and potential catalysts for future expansion. Risk assessment. Assess the risks associated with each sector, including industry-specific risks, economic factors, and external risks such as geopolitical events or regulatory changes. Evaluate factors such as competitive threats, cyclicality, market saturation, and potential disruptions that could impact sector performance. Qualitative factors. Consider qualitative factors such as management quality, corporate governance practices, brand reputation, and strategic initiatives. Assess the ability of sector companies to adapt to changing market conditions, execute growth strategies, and innovate in response to industry trends. Market sentiment. Take into account market sentiment and investor perception of sectors. Factors such as market trends, investor sentiment, and analyst recommendations can influence sector performance in the short term. Risk-return analysis. Evaluate the risk-return profile of sectors based on the sector's historical performance, volatility, and potential for capital appreciation or income generation. Determine whether the potential returns of the sector justify the associated risks. Monitor and review. Regularly monitor the performance and news flow of sectors to stay updated on industry developments, earnings reports, and macroeconomic factors. Review and adjust sector allocations as needed based on changing fundamentals, valuation, and market conditions. It's important to note that fundamental analysis and valuation metrics should be used in conjunction with other analysis techniques and investment considerations. Market conditions, investor sentiment, and external factors can impact sector performance, so it's advisable to maintain a diversified portfolio across sectors to manage risk. Seeking advice from financial professionals or conducting thorough research can provide additional insights and perspectives when evaluating sectors based on fundamental analysis and valuation metrics. Implementing a value-based approach to sector selection and rotation involves identifying sectors that are considered undervalued based on their intrinsic value and potential for future growth. Here are the key steps to follow when implementing a value-based sector selection and rotation strategy. Identify sectors. Start by identifying the sectors you want to include in your analysis. This could be based on a predefined sector classification system, such as Global Industry Classification Standard, GICS, or specific sectors you believe have the potential for value appreciation. Conduct fundamental analysis. Perform in-depth fundamental analysis on companies within the sectors to assess their financial health, growth prospects, and competitive advantages. Review financial statements, earnings reports, and industry research to evaluate key metrics such as revenue growth, earnings per share, return on equity, and debt levels. Valuation metrics. Apply valuation metrics to assess the relative value of sectors. Common valuation metrics for sector analysis include price-to-earnings ratio, P/E, price-to-sales ratio, P/S, price-to-book ratio, P/B, and dividend yield. Compare these metrics to historical averages, peer sectors, and the overall market to identify sectors that may be undervalued. Relative valuation. Compare the valuation of sectors to their historical valuation levels and to the broader market. Identify sectors that are trading at lower valuation multiples compared to historical averages or sectors that have a lower valuation than the overall market. This indicates potential undervaluation. Growth prospects. Evaluate the growth prospects of sectors based on industry trends, market demand, technological advancements, and macroeconomic factors. Look for sectors with solid growth potential that may be currently undervalued by the market. Consider factors such as new product development, industry innovation, and emerging market opportunities. Qualitative factors. Consider qualitative factors such as management quality, competitive position, regulatory environment, and company-specific factors. Assess the ability of sector companies to generate sustainable growth, execute effective strategies, and adapt to changing market conditions. Risk assessment. Evaluate the risks associated with each sector, including industry-specific risks, economic factors, and external risks. Identify potential risks that could impact the sector's growth prospects and overall valuation. Assess factors such as competition, regulatory changes, and technological disruptions. Diversification. Maintain a diversified portfolio across sectors to manage risk. Allocate investments to sectors that are considered undervalued based on the value-based approach, but also consider the overall risk profile of the portfolio. Diversification helps spread risk and reduces exposure to any single sector. Monitor and review. Regularly monitor the performance of sectors and review their valuation metrics. Monitor news and market developments that may impact the sector's valuations and growth prospects. Review and adjust sector allocations as needed based on changing fundamentals, valuation, and market conditions. Patience and discipline. Value-based investing requires patience and discipline. Undervalued sectors may take time to reflect their intrinsic value, and the market may not immediately recognize their potential. Stick to your investment strategy and avoid chasing short-term market trends. It's important to note that implementing a value-based sector selection and rotation strategy involves inherent risks and uncertainties. Market conditions, investor sentiment, and external factors can impact sector performance. Regularly reassess your investment thesis, monitor market conditions, and consult with financial professionals to ensure your investment decisions align with your financial goals and risk tolerance.